everyone. Happy Wednesday. It is October the 27th. It is pouring down rain outside right now. Kind of made for an interesting morning to say the least. Anyhow, my name is Mary. I am with Coldwell Banker Realty here in Cypress, Texas. I'm here today to discuss the real estate market and important terms that you should know along your adventure. First and foremost, congratulations if you've contemplated purchasing a home. It is a spectacular adventure, one that many thrive on, and obviously it's one of the best wealth building processes a person can have or endure in their life. So right now, today, Wednesday, October 27th, I know it's crazy. Fall is almost here. The weather is changing. We're starting to see more cooler temperatures than our typical 80s, 90s, 100s. Anyhow, so about real estate terminology, things that you should really know when you're in the process of is obviously the different types of sellers that exist. You've got your traditional seller, which is someone like me. I own a home, and if I were to sell you my home, I am considered to be a traditional seller. You've got different types of transactions that are inclusive. You've got investor-owned properties, and that can be inclusive of people like Zillow or OfferPad or, good God, there's so many different others, or private investors for that matter. People like me that own investment property that rent them out or have a tendency of renovating them and flipping them. The other terms that I feel are important for the transaction are REO. Okay, now REO is real estate owned. What that includes is like bank-owned properties. So if a bank forecloses on a property, it turns into what we refer to as an REO. Bear that in mind in the process. Obviously, there's different types of sellers that exist. And you want to make sure that you understand with each type of seller, there's a different dynamic involved. Now, as you get into the REO process, which is real estate owned, bank-owned properties that have been foreclosed on, typically you have Fannie Mae and you have Freddie Mac, you have HUD, you have VA, and then you've got your Chases, your Bank of Americas, the various different lenders that exist that foreclose on properties. Now, there's a multitude of reasons that homes get foreclosed on. It could be because someone didn't make their payments, perhaps someone passed away, and they were unavailable to make those payments in the process of, and it was passing to a family member in probate. It could be that someone endured a financial hardship and it resulted in them losing the property. Now, the market conditions right now, you don't see a lot of REOs out there. That's not to say that they don't exist, because some of them do. And we are seeing an uptick right now in the number of foreclosures across the United States. Now, I don't expect it to be dramatic. And when I say dramatic, I refer back to 2008, 2009, 2010, when we had what was referred to as skeleton inventory. There were a lot of homes out there that were in the process of being foreclosed on, and pending which state you reside in, it could be either judicially mandated or non-judicially mandated. Now, a judicially mandated state means that they have to go through the proper protocol of the court system in order to actually gain access to the property. And in doing so, sometimes that process can take 6 months or it could take up to 5 years. And that depends on how savvy the homeowner is and the process, and whether they continuously go before the judge and say, hey, this is my situation. This is what I'm working on right now. I've been in contact with the lender. I can't go through this process. Maybe they're having additional hardships that have helped to facilitate that long process in itself. Now, a non-judicially mandated state like Texas, it can take weeks or it could take months. And so given the fact that we just went through a COVID process, and when I say a COVID process, I do mean COVID really put a damper on the foreclosures and helped to keep people in their homes when they couldn't afford to make their payments. So at that point in time during COVID, things weren't processing as normal. So same thing with evictions. The eviction process had slowed down. Now, things to bear in mind in this market right now, the way that we sit, we have a tight inventory, okay? An inventory is the number of homes that are available on the market in comparison to the demand. So we have a high amount of demand that exists. Everyone wants to buy a home, okay? Nobody wants to continue to rent. I don't blame them. I wouldn't want to either, because it's basically taking your money and flushing it down the toilet. Now, the climate that we're in right now, interest rates, which is your overall percentage that you're paying the bank for that loan, can range anywhere from 2.5% on up. Now, some of the factors that are involved with your interest rate are your debt to income ratio, your credit score, and your financial viability. So when you start this process, I always recommend to everyone, check your credit report, see what is on there, what is the largest credit line you have, the oldest credit line. Do not, and when I say this, do not close down any of your old credit card accounts. Try and keep as minimal balances on them as possible, because that does count against you in the process. So if you have a $2,000 credit line, rule of thumb is try and keep the balance on that $2,000 credit line to at least $400. That's maximum. Do not go above that $400 margin, because ultimately it impacts your debt to income ratio, and it affects how much of a home you can actually qualify for. So bear that in mind in this exact process for yourself. The other thing is, if you've got 15 credit cards, don't use all of them. Pick one or two, because if you have 15 payments out there for $50 a month, that too impacts your debt to income ratio. So make sure that you're keeping an eye on that. Any collections that you have on your credit card account or on your credit, that would be with Experian, TransUnion, Equifax. If they're older, don't contact them. Don't call. Don't make the attempt to pay it. You could pay those items at closing. So if you have the funds available to do so, but if you engage with them, it acts as a new account. And you don't want that, because ultimately it will affect your credit again, and it'll bring down your FICO score. And so in order to purchase a home, now a FICO score, another term that's extremely important, that is your credit rating with Experian, TransUnion, and Equifax. All three are significantly different in how they report. So it's important to know that going in. The best FICO score that one person can have is an 850. And so a good credit score is considered to be about 660 and above. If you start sinking below that 660, that's when you start to see your rate on your home increase. Now, you have what's called a fixed rate mortgage, and you've got what's called an adjustable rate mortgage. I highly suggest to anyone that's considering the process of purchasing a home, try and stick with a fixed rate mortgage. Don't go with a jumbo loan. Don't go with a variable rate, because ultimately how that works is when the Federal Reserve starts to increase their rates, the index on that increases, and it causes your payments to change. Now, as the Federal Reserve starts to decrease their payments, then you'll see a decrease in the amount that you're paying on that mortgage. But ultimately, the best bet is to go with a fixed rate mortgage. Now, the other term that's extremely important is contract, and that is your bilateral agreement, bilateral meaning you and the seller, whomever that may be, to purchase the property at hand. Now, a contract doesn't exist unless it's been signed by all parties inclusive, you being the buyer and the seller. Now, if you're dealing with an REO property, bank owned, again, then they have their own set of contracts that they submit to you to sign off on. Whereas if you're dealing with a traditional seller, you deal with a TREC contract 9 times out of 10. And the TREC contract is the Texas Real Estate Commission. Now, when you're in the process of purchasing a home in Texas, we have what's referred to as option fee and escrow. Okay, the option fee is a fee that you pay to the seller, and this fee provides you the leniency to actually perform inspections on a property. Now, that option fee can range anywhere from $50 to $1,000, pending you and the negotiations that you have with your realtor and the seller. And so this option goes towards your closing costs at closing. So that way you're not out any money. Now, the only way you don't get that option fee back is if during that option period, being 3 to 10 days on a rough end, you decide that the home needs too much work. You just don't want it. You change your mind. You don't like the smell of the house. Then at that point, during that option period, you can walk away from contract and you don't get that option fee back, but you will get back what's called your escrow. And escrow shows good faith that you intend on purchasing the property. And that can typically be anywhere from $500, $300 to $10,000. Again, it's whatever you negotiate with the seller and your realtor. So I would definitely speak with your real estate professional and find out what the going rate is typically at this point in the market where we stand. Now, the higher the option, the better your likelihood is of getting an offer accepted. And that's just unfortunate, but it's true. So if you went in with a $300 option on a $200,000 house, chances are the seller's going to counteroffer, and they're going to be like, hey, no, sorry, can't do 300. So if I'm going to pull my house off the market for you to obtain financing, then we're going to need a little bit more skin in the game. And so these are all things to contemplate throughout your process. Now, in the contract, it explicitly gives you what's referred to as a, good Lord, where's my terms today? The period for financing. And that's completely negotiable based off of what your realtor suggests in today's market, what your lender has to say, and how you feel about getting your documents in a timely fashion. Now, this financing clause, which is referred to as the third-party agreement financing, this is the process, or the time frame, should I say, for you to collect all your documentation and pass them off to your lender. And then they give you loan commitment or they decline your loan. And so typically it should only take a lender 15 to 20 days in order to get you that loan commitment. Now, outside of that loan commitment is the appraisal. The appraisal is done by the institution of which you're getting your financing through. And the appraisal shows the value of the home. Now, that typically takes a little bit longer than the financing period of 15 to 20 days, but that's also a clause within your actual financing third-party agreement. So if, God forbid, you were purchasing a home for $300,000 and that appraisal came back at $280,000, if you did not include an appraisal contingency, then at that point you would be at the $300,000, unless, of course, you're going FHA. Now, FHA is underwritten through Fannie Mae and Freddie Mac. So at which point there's more stipulations that are involved in that actual financing process versus a conventional mortgage. Conventional, you can put anywhere from 5 to 20% down, and it's really not based off of the appraisal unless you put an appraisal contingency in there stating that the home has to appraise at $300,000 in order for you to make that purchase, because you can't come out of pocket the difference on top of your typical down payment. I hope that this helps you today. Obviously, I'll be coming back and I'll be diving a little bit more into it. If you have questions and you want to know a little bit more about how the process works, I'd love to chime in with you and be able to help. I know that it's confusing when you start a process and you don't understand all the terms that are involved. So you're kind of like, oh my God, what am I signing? What's going on? And your real estate professional should go over that documentation with you to help better understand. And that way you know exactly what's going on. So again, if you have any questions, feel free to reach out to me. My name is Mary Dover. I am with Coldwell Banker Realty here in Cypress, Texas. You can reach me at 713-261-9879. You can also email me at mdover, DOVER, realty @gmail.com. And I'd love to hear any questions or concerns that you have with regards to the process. I am a veteran real estate agent. I have been doing this since 2004. I've seen the highs, I've seen the lows, I've seen the mediocrity that's been involved. And my position in where I sit right now is to be able to provide you with as much education in the process to where you feel comfortable. I don't want you to not be satisfied with the final outcome. Ultimately, this is your home. This is your final destination, hopefully, or one of your final destinations. So you want to make sure that the financial viability for yourself, it's affordable, A, and B, you just love it, because settling ultimately is not what I want you to do. I hope you have a great day. Be safe out there.